Welcome back to The Explainer. If you've been watching the financial news lately, it can really feel like we're all strapped onto a roller coaster that's missing a few bolts, right? We're seeing massive tech offerings, shifting geopolitical alliances, and fluctuating interest rates all at once. So how do we make sense of the chaos? Well, today we're going to step back, get a solid handle on the broader market trends, and then learn how to cut through all that daily noise using the timeless, structured principles of value investing. Let's get into it. Okay, let's dive into this. $56.4 billion. Just take a second to wrap your head around that number. That staggering figure is the fully diluted valuation of the recent Cerebras AI IPO. They priced their shares at $185, and they opened near $350. That is nearly double the IPO price on day one. By any measure, it was an absolute blockbuster debut, easily creating the biggest U.S. tech IPO since 2020. But when a number gets this big, this fast, it really forces us to ask a tough question. Are we looking at genuine fundamental business growth here, or are we simply witnessing a market swept up in pure euphoria? So here is our roadmap for today. We'll start with the 2026 macroeconomic landscape, then move into market euphoria and geopolitics. From there, we'll introduce the value investing philosophy, figure out how to calculate the Graham number, and finally, wrap up with how to navigate Mr. Market today. Section 1, the 2026 macroeconomic landscape. You can't really analyze a single wave without understanding the tide. Now, what's really interesting about this slide is the path of the Federal Reserve's target range midpoint from the March 2026 FOMC meeting. If you look at the actual and projected federal funds rate, it shows a slight downward trajectory in the medium projection as we move from 2025 into 2026 and 2027. Basically, the Fed is modeling a controlled, slight dip in rates. And this is absolutely crucial because this is the underlying heartbeat of the economy. It dictates the cost of capital for every single company. Actually, scratch that. It dictates the cost for anyone trying to grow or borrow right now. Building on that, let's look at the Fed's broader economic outlook. According to their March 2026 projections, we're looking at a remarkably steady baseline. Real GDP is projected to grow between 2.0% and 2.4%. Inflation is expected to converge back toward the Fed's longer-run goals, and the labor market remains super resilient with low unemployment. This is such important context for us. The macroeconomic baseline is actually quite steady, almost kind of boring. Yet, against this perfectly calm backdrop, we are seeing absolutely wild, aggressive moves in individual stocks. It's a really striking contrast. Section 2, Market Euphoria and Geopolitics. Over just a few short months, we've seen massive shifts in global dynamics. Let's track this. In December 2025, the U.S. allowed NVIDIA H200 exports to China, albeit with a 25% surcharge. By March 2026, Amazon Web Services signed a binding term sheet with Cerebras. Fast forward to mid-May, Cerebras goes public in that massive IPO we just talked about. And literally, the very next day, Presidents Trump and Xi held a business-first summit in Beijing, focusing on market access and trade. These are rapid, massive shifts in global supply chains and international trade policies happening back to back. With all this going on, it's really no wonder the market is reacting with such intensity. Let's look a bit closer at the Cerebras IPO, because it perfectly shows what happens when momentum meets reality. The AI growth story here is undeniable. We're talking 76% revenue growth in 2025, up to $510 million, and a master relationship with OpenAI reportedly worth over $20 billion at full expansion. It sounds unstoppable, right? But we have to contrast that with the concentration risk. The stock is trading at over 130 times sales, which is bordering on euphoric. Plus, about 86% of its 2025 revenue came from just 2 UAE-linked customers. And fundamentally, they're still operating at a loss. This extreme concentration risk, combined with that lofty valuation, is exactly why we need a disciplined framework to evaluate these kinds of opportunities. Let's move to and see how this builds. Section 3, the value investing philosophy. As Warren Buffett so perfectly put it, the essence of value investing is buying stocks at less than their intrinsic value. It sounds incredibly simple, doesn't it? Just buy things for less than they're worth. But executing this in the real world requires immense patience and discipline. True investors have to look right past the hype, the dramatic news cycles, and those flashy opening day IPO pops to find the real underlying quantifiable worth of a business. So let's break down exactly what we mean by intrinsic value. This is the actual underlying value of a company. You calculate it based on hard, cold data, the company's existing assets, its current earning strength, and realistic future growth. And here's the absolute most important part. This value exists completely independently of the current stock market price.
a company's true worth fluctuates way, way less than its daily stock ticker price, which, as we know, is often driven by human emotion and media narratives rather than fundamental business changes.
So the crucial point here is the margin of safety. This concept was championed by the father of value investing himself, Benjamin Graham, and it is the absolute lifeblood of the defensive investor. It is literally the difference between a stock's market price and its intrinsic value. You see, you don't just want to buy a stock at its exact fair value. You want to buy it at a discount. That discount is your buffer. It protects you against your own errors in judgment, unforeseen company troubles, or sudden macroeconomic downturns. The goal isn't just blindly chasing maximum gains, it's about systematically minimizing your losses.
Section 4. Calculating the Graham number. Finding the Graham number is actually a straightforward three-step process. First, you identify the company's earnings per share, or EPS, and its book value per share, the BVPS. Step 2, you multiply the number 22.5 by the EPS, and then you multiply that result by the BVPS. Finally, step 3, you calculate the square root of that final product. What you're left with is, theoretically, the maximum fair price a defensive investor should ever pay. The real magic of that 22.5 multiplier is that it simultaneously enforces strict constraints, capping the price-to-earnings ratio at 15 and the price-to-book ratio at 1.5. It's a really elegant, quick screening tool.
However, as an informed investor, you really need to know the limitations of this tool. For starters, the Graham number completely ignores future earnings growth. It also fundamentally requires positive earnings and equity. If a company is operating at a loss, the formula just breaks because, well, you literally can't take the square root of a negative number. And finally, it is purely backward-looking. When you try to apply this to a fast-growing, asset-light modern tech company like Cerebra's, which is currently posting operating losses, the Graham number simply cannot compute. It's a fantastic tool for traditional industrial and manufacturing stocks for sure, but it definitely struggles with today's disruptive tech sector.
Section 5. Navigating Mr. Market today.
And this brilliantly illustrates one of the best concepts in finance. Benjamin Graham famously personified the stock market as Mr. Market, a manic depressive business partner. Think about it. One day, Mr. Market is totally euphoric, convinced an AI IPO like Cerebras is going straight to the moon, and he offers to buy or sell shares at astronomical prices. The next day, he's terrified by a shift in Middle East tensions or trade tariffs, and he's willing to sell everything for pennies on the dollar. Mr. Market is entirely driven by emotion. So if you take one thing away from this explainer today, make it this. True value investors let Mr. Market serve them rather than guide them. When the news cycle is pumping up an AI stock to 130 times sales, the value investor politely declines Mr. Market's inflated offer. This is where you step in. You use the market's volatility to buy quality assets at a discount, when Mr. Market inevitably panics over a headline and drives the price of a solid, fundamentally strong company way below its intrinsic value. So I'll leave you with this question to think about. The next time an AI stock doubles on opening day and everyone around you is rushing in, will you buy the hype or will you calculate the margin of safety? Thank you so much for joining me on The Explainer today. Keep analyzing, stay focused on those fundamentals, and whatever you do, don't let Mr. Market dictate your strategy. See you next time.